So FHA loans in 2008, I believe it was like 1.9% of all loans were FHA. Going to 2009, I believe it was like 35%. It was a huge lift. FHA loans still only require 3.5% down. You can do multi-unit FHA loans up to 4 units where you can live in one unit. And as long as it's a self-sufficient property for a 3 or 4 unit loan, you can buy that property and actually create subsidized wealth from the other units. FHA loans are great because with no overlays, which we don't have, which is a good thing, a borrower can actually go down to a 500 credit score. So they're very forgiving on credit. FHA loans are also fantastic because they have a lot of cool little nuances where you can use what are called blended ratios, meaning you can have a non-occupying co-borrower and you can use the overall income and the overall debt. You don't have to isolate just the owner-occupied's debt to income ratio. You can use blended ratios. They also aren't really reserve heavy. So as long as you get what's called an automated underwriting system approval, you don't really need reserves. You might need a month or two, depending on how the AUS comes out, but they're very forgiving. The other thing is they have a lot of allowance in terms of their front and back end debt to income ratio. With no overlays, you can go to a 46.99% front end and a 55.99% back end, which is fantastic. So what that means is a client can buy more home with more debt. The other thing that's great about FHA loans is a lot of times we see a client maybe has 3.5% down, and we can structure almost closing cost assistance by a client paying a little bit more on the property, on the sale of the property, and then the seller actually giving a small credit to essentially pay for the closing cost, or we can give what's called a financing contribution, which may enable the client to have only 3.5% down. The way FHA loans work is you have 2 forms of mortgage insurance. One is your monthly mortgage insurance payment, which is generally calculated by the base loan amount times 0.85 divided by 12 to give you that one monthly installment. The second is what's called your UFMIP, upfront mortgage insurance premium. And how that's calculated is it's essentially the base loan amount times 1.75%. That number gets refinanced back in the deal to give you your final loan amount. So I know a lot about FHA. I've been doing them since 2009. It's a great product. When rates drop, you can also do what's called an FHA streamline. You have to have a half-point rate drop to meet what's called a net tangible benefit. It's a great product. We do them in-house. We close them in 2 weeks. There's sort of a misconception that FHA loans are harder. They're really not. You only have to have a condo approved FHA complex. However, there's also ways to do FHA loans on a non-approved complex as long as you go through those steps. So I'm the expert at them. Call me. Let's do an FHA loan today.